Hi, I'm Kenny Roo. Welcome to Kangaroo Energy, where we share practical knowledge on energy, money, technology, innovation, and everyday life. We have something important today. Let's get into it. Hi, I'm Kenny Roo. Welcome to Kangaroo Energy, where we share practical knowledge on energy, money, technology, innovation, and everyday life. We have something important today. Let's get into it.
Hi, I am from Kangaroo Energy. Everyone keeps asking the same question. Is Australia's housing market about to crash? You've probably seen the headlines. Prices are too high, mortgages are stretched, young families can't afford deposits. Surely this can't continue. But what if the real story is the opposite? What if the data is actually pointing toward continued price pressure, not a collapse? In this video, I'm going to walk you through 5 critical market forces that challenge the idea of a housing crash. And by the end, you'll understand why supply, interest rates, and lending conditions are creating a very different outlook than the one most people expect. Let's start with price momentum. Over the past year, we saw a brief cooling period, but recently growth has started accelerating again. This is just the first force. Follow for part 2, where I'll explain why interest rates and supply shortages are changing the game. Welcome back to part 2. Let's look at why interest rates and supply are driving the market up, not down. Property markets don't move randomly. They respond strongly to interest rate cycles. When the Reserve Bank cuts rates, prices tend to respond quickly. Lower borrowing costs increase buyer capacity. That brings more people back into the market. Demand rises faster than supply can adjust. If we enter a sustained easing cycle, history suggests upward pressure on prices rather than downward collapse. Now let's talk about supply, because this is where the real tension sits. Australia currently has a structural housing shortage, not a theoretical one, not a projection for 10 years from now, a shortage happening today. When households grow faster than homes are built, pressure builds. Rents rise. Sale prices rise. When demand exceeds supply, prices rarely fall. That's supply. In part 3, I'll explain why construction delays and affordability are actually making things worse. Follow for more. Welcome to part 3. Why don't we just build more homes to fix the shortage? That brings us to construction delays. Building timelines have stretched significantly. Apartments and houses take far longer to complete due to complex planning, labor shortages, and rising material costs. Even if governments announce big targets, the physical reality of delivery is slow, and slow supply means prolonged pressure. Now let's look at affordability. Housing is significantly more expensive relative to income. That sounds like a reason for prices to fall. But here's the twist. Affordability constraints don't automatically cause price crashes. Sometimes they reduce new supply instead. Developers rely on deposits to secure financing. If buyers can't afford deposits, projects get canceled. That reduces future housing stock even further. So, affordability pressure can actually worsen the supply imbalance instead of correcting prices. In the final part, I'll tackle the biggest fear, mortgage stress. Does it lead to mass defaults? Follow to find out. And now the biggest fear people talk about, mortgage stress. Many believe that high rates must lead to widespread defaults. But current arrears data tells a different story. The percentage of loans seriously behind on repayments remains historically low. Why? First, lending standards over the past decade have been much tighter. Borrowers were assessed at higher serviceability buffers. That built in resilience. Second, unemployment remains relatively low. Most mortgage stress becomes dangerous when people lose income. Without widespread job losses, forced selling pressure stays limited. Third, many households built savings buffers during the pandemic period. That created additional breathing room when rates rose. For a true property crash, you need forced selling at scale, usually driven by high unemployment or loose lending. At the moment, those ingredients don't appear dominant. So what does all this mean for the final outlook? Join me in the final part to wrap it all up. Follow for the conclusion. So what does all this mean? It doesn't mean property is easy or risk-free, but the crash narrative misses the structural reality. We have stabilizing interest rates, a massive housing shortage, slow construction pipelines, and strong loan performance. That supports resilience, not collapse. For first-home buyers, waiting for a crash may not be a strategy. For investors, understanding these supply dynamics is critical. Always look beyond emotion. Markets are driven by incentives, supply pipelines, and credit availability. Connect those pieces, and the picture clears. The housing challenge in Australia may not be a crash story. It may be a supply and affordability story instead. And those two things lead to very different outcomes. Subscribe for more videos, like, share, and stay informed.
Hi, I'm Kenny Roo. If this helped, please like the video, subscribe to the channel, and comment what you'd like us to cover next. Hi, I'm Kenny Roo. If this helped, please like the video, subscribe to the channel, and comment what you'd like us to cover next.